Hello and welcome to another episode of the Consumer Credit Matters podcast. I'm your host, William Black, and today I'm joined by Adam Reeds. Adam is the CEO and co-founder of a company called Ledn. Ledn makes fiat loans to holders of Bitcoin. And just last month, Ledn closed its inaugural and I would say groundbreaking transaction. This was a Bitcoin-collateralized loan ABS transaction, $200 million issuance, rated BBB minus by S&P, groundbreaking in many ways, also familiar in many ways. It was issued during a time when Bitcoin dropped, really one of its most precipitous drops in recent memory, almost a 30% drop in Bitcoin, while the transaction was pricing, putting to test some of the structural mitigants, operational features of this transaction. Certainly worth understanding if you're a student of securitization or follower of consumer credit in general. The first data point, I would say, of what a functioning Bitcoin ABS transaction looks like. So if you're interested in this type of thing, do stay tuned. All right. Adam Reeds, welcome to the Consumer Credit Matters podcast.
Great to be here. Well, how are you today?
I'm doing great, thanks. So, Adam, very quickly, if you wouldn't mind introducing yourself to the listeners, and then we'll get right into that transaction.
Sure. Well, thanks everyone for listening in. I'm Adam Reeds. I'm the CEO and co-founder of Ledn. I grew up in Canada. I went to school in a university called Western and studied mechanical engineering and business there, and then cut my teeth out of school in renewable energy. So first worked for a developer and then joined a larger publicly traded asset management firm that also managed some pension fund money as well. And we invested in renewable power projects really across the globe, but with a focus on North America. And that's how I learned really about structured finance. I credit my university days for introducing me and the opportunity to meet my co-founder Mauricio. And that was the preface to starting Ledn, was meeting him. Many years later, Mauricio introduced me to Bitcoin. And really the thesis of Ledn was sharing my experience with money and saving and investing growing up in Canada versus his experience with the same growing up in Venezuela. And for those of you that followed the Venezuelan story, and if you're sitting in America, Canada's not too different as far as financial services and access. Canada versus Venezuela couldn't be further apart as far as access. And so, for lending specifically, lending is for the wealthy in Venezuela. You can access loans, frankly, when you don't need the capital, but you want to take advantage of currency arbitrage and other types of financial instruments. And for Canada, as long as you follow the rules and fill out the right paperwork and have your credit score in a decent place, loans are available. And so that was really the initial setup to starting our company.
Gotcha. Thank you for that. And yeah, I mean, Bitcoin is I want to say, at least the people that I speak to, has been more of, I would call it a hobby or, a speculative asset that people venture into. And then of course there are people who are pushing the envelope and true believers. I think, what is it called? HODL, right?
HODL, yeah.
Right?
HODL, yeah, that's right.
I'm still trying to get up with the lingo, but the hold on for dear life crew who have been in from the beginning, right?
Exactly.
Yeah.
Yeah. No, it's. I was going to say, Bitcoin is the first asset that's the same to everybody globally, right? And that's what made it unique. Going back to my renewable energy days, some of the frustration I would look at is Canada had incentives for example, solar power, but in most places in Canada, there's some are sunny places, but on a degree of sunlight and relative angle to the sun, it's not that great of a place for solar energy, right? But other places like the Caribbean, there's lots of sun, but because of property rights and regulation and other attributes that make it jurisdictionally more difficult, it just isn't as prolific. And so I think what's really neat about Bitcoin is the same asset to everyone globally, and because of that construct, we were able to think about how to equalize lending opportunities and open it up to the world. So that was, again, why we chose to focus on it as an asset.
You're talking about a large group of investors, I'll call them, believers, you called them, around the world who have varying shares of their wealth, in some cases a very large share of their wealth, and very large amounts of Bitcoin on paper that they don't want to liquidate. Thus the name Hold On for Dear Life. They don't want to liquidate it. They don't want to sell it, but they want to be able to live, based on, call it, the book value of that asset, that speculative
Yeah.
asset. And so the question is, how do you access that wealth without triggering a sale, which has other consequences, tax perhaps? Obviously, you have to sell the asset that many people believe still has a lot of room to grow, right? And that's where your company comes in, right? Because you're providing them with a loan against the value of that Bitcoin, and they can access that wealth and, I don't know, live large or live larger than is available to them. If they just had to transact in Bitcoin, because that's still in most places very difficult to do.
Yeah, exactly. So we were actually in Bitcoin mining ourselves. So when you're mining Bitcoin, you're earning Bitcoin as a revenue source, but then you still have expenses in traditional fiat terms. We saw lots of opportunities where the price was increasing pretty rapidly in fiat terms. And so we wanted to keep that hard-earned Bitcoin. And so we wanted to think about how to use it as collateral for a loan versus sell it directly. And so to your point, well, in most jurisdictions, when you sell Bitcoin, it's a capital gain. And so you're paying tax on that gain, and you're of course losing the upside. And for those that
Right.
have been in Bitcoin for many years, they know that it's had a 40% CAGR for many years from inception. And so if you can hold on to it, all history has shown is you've done extremely well. So there's even more of a reason not to sell it. And so that was what we really thought about developing with the loan. So to go into the structure, our borrowers can borrow as little as $500 US dollars. We don't really have an upper limit, but our largest client on the platform has borrowed 20 million. We
Wow.
do fit in the consumer segment. And so some say, oh, high net worth retail. I just say consumer.
Hmm.
And so,
Hmm.
individuals and small businesses who want to hold on to Bitcoin for the long term. And then the structure of it is really similar to how, equities margin financing works, right? When you say, I want to borrow dollars against my Meta stock at my JP Morgan account, they'll give you a certain amount of a percentage of the value of the stock. And we do the same with Bitcoin. So
Gotcha.
we start at 50%. And then similar to how equities margin financing works is then we have different triggers based on the price of Bitcoin. So if the price of Bitcoin falls, and then so you're starting at 70%, or sorry, 50% LTV. If the Bitcoin falls a little bit, so the loan to value is 70%, then you're going to start seeing warnings and reminders to keep your loan in good standing. And then if it should fall further and it gets to 80%, Ledn without discretion liquidates enough Bitcoin to repay the loan, and it's fully closed out. Reverse happens as well. If the price of Bitcoin increases, clients can rebalance and take some of that Bitcoin back from the loan, and either keep it in their own self custody or do as they please with their excess Bitcoin collateral. And so it's a balance. And then of course through that, as the Bitcoin price is changing, clients can top up and add more Bitcoin as well to keep their loans in really good standings. We've done billions of these loans, from inception. Overall, Ledn's done 11 billion of Bitcoin and related other types of loans that we have on the platforms. Lots of experience and data, and I should have mentioned in the introduction, but we started Ledn in 2018, in August
Hmm.
of 2018. So this is it'll be our ninth anniversary in August of this year running the company.
That's actually, we'll come back to that, because what that tells me immediately is that you've been through a few crypto winters.
That's right.
There's been
Yeah.
a few of them, and I think that's an important, again, these kind of the scar tissue that you can build up by going through these, and they've all been kind of, they've had different flavors, different genesis to those winters, and some argue that we're going through another one now. But I don't want to get too far ahead of the conversation. You
Sure.
brought up the loan structure. I think that's obviously key to the securitization. One of the key strengths of the securitization, and just for folks to understand, I think you're absolutely right to compare this to like margin lending, often against securities. The big difference, of course, is that that Bitcoin trades 24/7.
That's
which
right.
is a strength, right? So you can liquidate it. In theory, you can liquidate it. Well, in theory and in practice, you can liquidate it at any given at any given moment. Um, uh, uh, Unless something operationally falls down, something operationally breaks. Again, and that's that. I don't want to gloss over that risk either too quickly, because that's another risk that I'm sure you and other parties to the transaction thought very deeply about. And you have some third party oversight and belts and suspenders and some real credible names there that brought a lot of, I think, risk mitigation to that transaction. Again, we'll get into that, but do I have that right? You have the loan features that you talked about. Basically, again, to reiterate, you have an LTV that is very safe at the start. You said 50%. If things
That's right.
deteriorate, the borrower is given an opportunity to top up at, you
That's
said
right.
70, and I think 75 is the other
Yeah.
trigger. And if they don't top up by 80% LTV, then you have the unilateral right and ability to liquidate that collateral position, the Bitcoin. You sell the Bitcoin is in simple
Yep.
terms, to ensure that that you're going to get repaid, or in this case also that investors are going to get repaid, right?
Exactly right. Yep. Yeah. And just to explain the market structure of Bitcoin, maybe that's worth diving into as well. So
Yeah.
Bitcoin trades more like foreign currency trades, that there isn't one centralized exchange, like, all Apple stock would clear on the NASDAQ, right? So there isn't one exchange. And so there's exchanges really all over the world, and you can even do, peer-to-peer transfers, right? So, well, you and I could agree on the price of Bitcoin, and I could trade directly with you. And that's what's unique about it. It also creates, I would say, some education needed around what is the true price of Bitcoin, right? Because if
Mm.
you have all these different exchanges happening, and many different venues trading, you need to agree on like a centralized clearing price. And so that's in itself been solved a little bit by the advent of the Bitcoin ETFs. So companies like BlackRock bringing the ETF to market, now, quite a while ago. But when you agree on, or when you bring that into the SEC framework, you of course have to agree on pricing to calculate NAV, and you have to have a certain amount of units per a Bitcoin units per ETF units. So in itself, that's kind of agreed on that. So there was some precursors and market structure that has been happening, that I would say helped Ledn create the bond as well, because we didn't have to reinvent the wheel on eight different topics. I think everybody, when they're building, builds on the work of other companies and inventors in the space. So all to say, what started as a very opaque, kind of unique market. There's a ton of transparency now, and a ton of regulatory framework that's come in to the Bitcoin market, that's really helping credit products like Ledn's ABS succeed.
Well, you mentioned the exchange rate complexity. If I'm correct me if I'm wrong, but that was one of the things that there was a crypto winter that kind of had that genesis of failures at the exchange node, I'll call it.
Yeah, that's right. I mean, we could talk about some of the different cycles. It's kind of interesting to reflect on it. I mean, we started the business in 2018, and that was right, really kind of after the whole bull market of the 2017 market, right? And that was,
Hmm.
starting the business around then. The theme at that was like, Bitcoin was still this, like, Warren Buffett's phrase, rat poison. People didn't want to talk about Bitcoin. Bitcoin was bad, and all of this, crazy nomenclature that was, in my opinion, very false. But at the height of that cycle was really about blockchain, not Bitcoin, right? And this whole idea that, okay, Bitcoin had invented this technology that, created these decentralized ledgers. But we don't want to talk about Bitcoin, but we're going to talk about the technology that exists. And that was also the advent of a lot of the, ICOs and companies raising money using tokens instead of going the traditional route, which ended up a lot of the cases, breaking a lot of securities laws, really, right?
Hmm.
But I think that was really the hype cycle of of 2017, then the 2021 cycle was, I think, the institutions coming in and some really big names, fairly large, regional, decent size banks in the U.S. getting into it. There was Silvergate, Signature, these banks that were very crypto friendly, and then some very very well funded venture capital businesses in the space, and Ledn raised a lot of venture capital in 2021 through that kind of post COVID ramp up. And then that was ended by, unfortunately, some fraudulent activity from a major U.S. exchange called FTX, which was one domino in a series of dominoes. And I think now this current cycle has been more about regulation and frankly a lot of the work that a lot of major institutions did in the 2020, 21, 22 period coming to fruition, because all these boardroom conversations don't happen overnight, right? It takes time
Right.
to build consensus and say, okay, this is a good idea. But I think that's really what we saw, was the work happening from many things. And the same thing when Ledn, when we've again been marketing what we've been doing, is like you can tell some of the groups we've been talking to have been doing work for several years, and now they're like, okay, this is the structure that we can get our head around. This is the type of activity that we can get comfortable with because we've analyzed all these risks and built consensus for many years now. So yeah, the booms and busts kind of help move everything along.
Yeah, and let's dwell on that a little bit. I want to go through, because the booms and busts again have created a stronger ecosystem. You have a very strong custodian in this transaction. Maybe you can speak a little bit about that as well. And you have backup servicing, which again, these are all staples of any other structured finance transactions. You brought all these structural features to bear with very credible third parties. Maybe we should go through each one of those, because I think these are important, kind of what I refer to as belts and suspenders to the transaction, that are traditional, tried and true structural features, but you're bringing it to a new asset class and worth going into for this particular transaction.
Yeah, sure. I guess first I'd just say, I think when you're trying to do anything new and innovative, you want to limit, to counteract what I just said, things that are new and innovative where
Right.
possible, right? So we're introducing a new asset here, which is Bitcoin. But what we tried to do is where not needed, not change other things that investors were used to give comfort, right? So I
Uh-huh.
would say, like, if you're going to do something innovative, just change one variable at one time. So what we tried to do is put all the similar blocks that were built up to do, like, let's say, auto loan financing or credit card financing, other types of assets that were really common for asset-backed security structures. So first off, what we did was we used a credible custodian called Fidelity, the same
I've
traditional
heard of them.
finance. Yeah, exactly. So we said, okay, let's pick a name brand that investors are comfortable with. And so they can, it's like you want to go through and present something, and then you want to hear people say, like, no further questions, Your Honor, right? That's the
Right.
activity you're looking for as you go through that. And brands and experience really help with that. They help build comfort, and that there's expertise there. So so we took approximately 5,000 of our existing consumer Bitcoin backed loans, vended them into a new trust, and then moved the collateral, being Bitcoin, associated with those loans into Fidelity as the custodian. So Fidelity, when you think about Bitcoin custody, you also have to break it down into technical custody and legal custody. I use those two
Okay.
frameworks because people get really concerned. Well, how do I know the Bitcoin isn't going to get hacked, right? So that's where technical custody comes in. That's the expertise to keep effectively the passwords to Bitcoin, which the industry calls private keys, offline and secure. So that's what Fidelity has done. They've invested a lot of money and time to say, this is the security practices we're going to put around our Bitcoin custody. And then they also act as traditional legal custodians. Ledn, as sponsor of the ABS, can say to Fidelity, move the Bitcoin here. And then, just like a traditional custody arrangement, if for whatever reason Ledn is no longer in business, group, the investors taking security and stepping in to resolve that concern, can say to the custodian, Fidelity, we're now in charge. Move the Bitcoin here, right? So it follows a traditional custody framework on those two attributes. Um, Importantly, investors also said, well, we're not in the business of liquidating or servicing Bitcoin. We want to also know that there's someone with expertise. So we brought in Zaria, which is a company that comes from actually the founder was previously at Silicon Valley Bank and working on some of their practices coming into the space. So was up to speed on Bitcoin financing, and she saw this as a gap in moving along Bitcoin-backed loans, and so she created a company specifically around creating backup services for products like Ledn's as it came in. So they've been great to work with, and so they're another piece of the pie as
And
we
I should
assemble it.
I
Yeah,
should mention very quickly, Emily Barron is who you're speaking of, the CEO,
that's
the
right. Yeah.
co-founder of Zarya, I should say. And just for listeners, if you're interested in that aspect, Emily was also a guest on the podcast, and we went, we took a deep dive into what Zarya does and how, and it was prior to your transaction. We actually didn't
Oh,
didn't
cool.
discuss your
Okay.
transaction
Yeah.
on the pod, but we talked about that the importance of having a backup servicer on transactions like this. So just if people want to take a deep dive on that, but yes, super important, right? I mean, you mentioned.
Hmm.
I know it's really hard for a co-founder of any stripe to think about their company not being around. But once you start issuing public transactions, especially at the rating thresholds that you cross now, the hard questions come about what happens when things don't go according to plan. And that includes a default or bankruptcy of the originator or the servicer or these
Hmm.
really important parties that have active roles and
Yeah.
ongoing roles in the performance of the cash flows and the loans and the securitization and so on and so forth. So yes,
Yeah.
you need to have these belts and suspenders in place. So you've mentioned two of them already, the custodian and the backup servicing. And maybe you can also talk a little bit about, you mentioned, you touched on the pricing mechanism, I guess, to what are the mechanics for your transaction in obtaining a market price?
Yeah. That was one of the key things. So the other, I'll just mention first. So S&P Global was the rating
Oh, of
agency
course. Yes.
major firm that stepped up and rated the overall securitization. And so obviously a very prominent name and someone that we worked with for over a year to bring them up to speed, and lots of questions and due diligence that went into that. But yeah, they were able in the end to rely on Ledn's own price oracles because we were able to demonstrate that it's tight enough to market. But I believe, if I'm not misspeaking, I think a lot of the ETFs rely on CF Benchmarks, which is a company that has developed an aggregation. I think they use like some weighted average, across different major trading venues, probably Coinbase, groups like Coinbase, Kraken, others that have transparent pricing coming in. So that's who the ETFs would use. We use to trade and sell Bitcoin at Ledn. We use a price aggregation software that looks at some of the major liquidity venues as well. And then again, we had lots of data and information to show that this is how the liquidations perform. This is the price. This is the price we need to liquidate. This is how far we were away from that weighted average mean price. And that's how we got S&P comfortable with it. That there was just really, it comes down to liquidity, and then how is your technology executing in those events. And so, because we had 8 years of data, we had ample data to demonstrate that all of that was working well. So I would say it's more of a misconception. And then again, like, is there enough liquidity? Is there enough, how tight is the pricing in these events? Than reality. And so that was, like, again, what we worked through to get them there.
Yeah, and I definitely don't want to gloss over the rating agency aspect of this, especially given where you landed on the senior bond rating of triple B minus, just above the investment grade threshold, which has a lot of at least symbolic meaning. It certainly opens up the investor base. Um, and maybe that's a good segue to talk about the mechanics that you have in place on paper uh, actually got tested in real time as you before the transaction even closed. So I think you launched the transaction and it was in pricing mode, and then we had a sudden and severe, I think 30+% drop in the price of Bitcoin. Couldn't have come at a worse time, in other words, but it really tested some of the uh, operational mechanics of your transaction. Spoiler alert, they worked. So maybe you could walk us through some of those mechanics and how that played out.
Yeah, and I guess, just to react to that, I think I could have ended with that. feeling that it couldn't have come at a worse time. But because of the fact that, things did perform as planned and we were able to demonstrate this real time, it actually added a ton of investor confidence as we were experiencing these events. So I'll get into what they were and then I'll talk more about that. But it reinforced what we were already saying. So I actually think it helped close and helped bring in more investors than maybe would have been on the sidelines if things would have went differently. But so what William's speaking to is to set up the ABS structure, we had to agree on the parameters. So we couldn't say, hey, we're thinking about these loans, but the way the actual legal process works and some of this is prescripted, we can't really, there's not flexibility in this, is you have to tell investors what they're financing. And so you have to pick a certain amount of loans. And so you have to tell investors, these are the 5,000 loans that you're going to be financing. And here's the exact parameters. You can't really say, well, I'm thinking about this. No, you have to give exact specifics. So we picked the exact loans, we had to pick a date and time that those loans were there. And then real world is happening. Real world is, some of
Right.
those borrowers are just having to repay their loans. Some are topping up their loans. So again, you have to be static with the information, but in reality, there's dynamic things occurring. So then we start to market, and then the Bitcoin price goes through a period of pretty intense volatility in February when we're actively marketing the product, and we experienced some liquidations. And so we vended in approximately $200 million of loans. And then we had an event where a significant portion of those loans, the Bitcoin had to be sold. And so that was as designed. We also had a lot of borrowers top up their loans,
Hmm.
more so that were liquidated, which is also an important aspect to mention. But because some of the Bitcoin was liquidated, a portion of the portfolio no longer had active loans and instead had cash. So to me, that's, again, from not a great experience from the borrower. So something that we don't want to happen from our own portfolio growth. But from an investor standpoint, financing cash versus financing a loan is a pretty good deal because you have the asset there, of course. And then what happens is once we're closed, Ledn had a whole bunch of extra loans sitting over here that we were able
Hmm.
to vend in and rebalance. So it was just a time gap that was occurring, and so this was something that was a little bit misunderstood. There was actually an article picked up by the Wall Street Journal that said, "Oh, this is not going according to plans because there's been some liquidations," and it was actually the opposite. It's going exactly according to plans.
Right.
We of
Right.
course can't control the market, but importantly, what we say to our clients all the time is we liquidate exactly at 80% loan to value, and it is without discretion. The minute we start saying, oh, here's a bit more time, you're actually adding risk to other
Sure.
borrowers who are following the rules, right? And so you can't favor one portfolio of borrowers against the other. If you're going to say you're going to trade it, and then vice versa, if you're liquidating Bitcoin at say $70,000 US dollars for Bitcoin, and then the price continues to fall, that borrower is going to be angry that you didn't liquidate them at 70K and now their Bitcoin collateral is sitting at 60K because
Right.
you have to be prescriptive with the rule. So again, that's what happened is, we've got a portfolio of loans over here. Some hit the parameter needed for liquidation. They were liquidated. But then once the ABS closed and everything happened and we were able to rebalance everything, we simply moved that cash out, moved loans equivalent to that cash back in, and then we had adequate interest coverage and everything like that again for the portfolio. So
Yep.
um, that was the important aspect of it is like, don't worry, this was just a time event. And
Uh-huh.
that also was a bit longer because again, we were marketing it. Now we rebalance every single week. So it's
Right.
it's different than what was
I,
occurring.
I didn't realize that was longer than it would normally take, but that's a good point to make. So let me see if I just recap this real
Yeah,
quickly because
sure.
this
Yeah,
is critical. One point is that yeah, rough numbers. This transaction was about a $200 million deal in total, and you experienced because of the rapid drop in Bitcoin prices about a $50 million of that 200 million
that's right. With
was kind of
25%.
cash
Yep,
collateralized. Essentially, as you said, you had to liquidate the underlying Bitcoin, and therefore the deal was fully backed either by these Bitcoin loans or the cash, right?
correct.
Um, and the cash, and again, by design, I think this is what they call a 3-year revolver, right? So it is by design meant to revolve, meaning take proceeds and invest them in new loans as either you liquidate or people pay off their loan, right? One of those two things
Exactly.
would
Yeah.
would would trigger you to reinvest during that revolving period, and then we'll talk about the legal final later. But so this was all part of the mechanics of the transaction. It just so happened that it happened during pricing, which is, a little bit more drama perhaps than people signed up for. But as you said, it worked. So while you're holding cash, I just want to point this out. You don't want to hold cash, right? Because it's not
Right.
earning anything. So you want to minimize the time you're holding cash. But you have, what is this? What percent of this is your loan book?
Yeah, it was that at the time about closing. Yeah, it was about 20% of the
Okay.
overall loan book.
So in other words, you have a lot of other loans that you can reinvest in, and which is exactly what you did to make up for that 50
Exactly.
million. And so now you're back to kind of where business as usual, I'll call it, where you have the Bitcoin backed loans collateralizing the securities as designed, right?
Yeah, and that's the portfolio is always growing as well, right? So we're doing our best to originate more loans, and you nailed the point specifically. So it's how relative it is to the amount of other loans we can vend in and resize it and rebalance accordingly.
Also fodder for future transactions, which we'll get
That's
into.
it.
I want
Yeah.
to ask you though, before we get to that, I wanted to ask you about the legal final, which is usually an extended period of time meant to capture all sorts of kind of edge case scenarios that would slow down or get in the way of the call it the natural liquidation of the collateral. And here I'm using collateral generically because this is true not just of your transaction, it's true of almost all ABS, all asset-backed securitizations of any stripe, of any collateral type, right? So you had a legal final that I think went out way out in the future, like 2041 or something like that. Can you comment on, I don't know, the math behind that or the thinking, even just conceptually behind why there is such a long legal final, especially given, and I don't think we talked about this, that the loans are all 1 year revolvers, right? They're 1 year balloon loans, right? So uh, basically, you're lending the money for a year and you have the option to either extend or renew that loan for another year, I guess,
Mhm.
or they have to repay it, right?
Yeah, I think that, and my understanding of why we were able to push it out that far is because we had some self-amortizing aspects built in there as well. Like I think,
Mm.
if there was a certain amount of, if we had a certain amount of cash sitting, or there's other, I think, triggers that would cause the whole thing to be repaid. So I believe that's why, we were pushing it out, is we able to show that, again, if, like, for example, there's a whole bunch of liquidations and we don't have new loans coming in, we're not going to meet the interest rate coverage. So that would cause it to pay off. So I think there's a bunch of other structural things that are happening in there that would prove to investors that they would get their cash before that long legal final.
Well, not to mention one of the structural features that I thought was very interesting and clever was after the revolving period is over, borrowers could no longer capitalize the interest expense on their loans. They had to come up with cash, hard cash, to pay the interest on their loans, which is, I mean, if nothing else, it's just providing an incentive for people not to renew those loans. So it does, I assume, just from a call it a consumer behavioral perspective, would certainly put your thumb on the scale of them wanting to pay off their loan rather than extend it again.
Yeah, and there was, some concessions made to work with S&P and ensure them that there would be adequate cash cover to cover the interest and principal expenses, obviously to keep the borrowing current. The
Uh-huh.
structure, to go back to the structure of our consumer loans, from inception, Ledn has never required interest or principal. Everything's been bullet payments, right? And that's because you have to put yourself in the mindset of a borrower. They have Bitcoin, they do not have cash. So the idea of saying, okay, you're going to put up your Bitcoin, and then in month one, we're going to ask you for a bit of the cash back that we just lent you, didn't make a lot of sense. So we were comfortable with accruing the interest and principal until the end of the term.
Mhm.
Now that's fine and dandy, but when you put that in an ABS structure, S&P rightly so said, okay, you're promising to pay interest monthly. how do you do that? Right. So we had to do a whole bunch of modeling to show them, some loans are renewing, the renewals can be used. And then we've also agreed. So, a year after the premise, we are looking at the structure of the loans and looking at how to keep a portion of that interest current. And so again, this is like, frankly, covering ourselves if in 3 years none of that happens, demonstrating to S&P and the investors that therefore participated that there will be cash coming back to pay it. So this is kind of like I would say it's again one of these kind of worst case scenarios that like if we don't make product changes and if we don't have cash coming and if there's no other loan product to take out the ABS, then this is like how we get investors back their cash. But it's not something that we anticipate actually happening.
Gotcha. And you mentioned Bitcoin. Bitcoin is clearly a global. I'll call it a currency, although that is sparked some debate as well. Certainly, asset. Is that is it, do you have borrowers from any jurisdiction around the world, or is this relegated only to U.S. domiciled or some country specific domiciled borrowers? How does that work?
Yeah. So at a high level, we lend everywhere we can within, obviously covering off regulation and compliance.
Hmm.
Exceptions would be, of course, in that same vein, no OFAC countries, no sanctioned individuals, all of the general compliance areas. There are some countries that we've chosen not to lend to currently just because the perceived risk from compliance outweighs the amount of interest we had in those areas. So, generally countries that may be under war or, other broader sanction challenges right now.
Hmm.
But we do lend in over 100 countries. And so some of the aspects that S&P put on the ABS or asked us to put on the ABS that I think will change over time is there's concentration limits by country.
Hmm.
So I think we have a max 75% concentration limit in the US. I think other countries is max 25%. To me, those things don't make a lot of sense when you're dealing with Bitcoin. It's not like, mortgages where they could change the property rights rules and, things like that affect the collateral package. Again, all of the collateral or underlying collateral is sitting with Fidelity. So you're not like having repossession risks or other things where local laws would really play a big impact on the credit analysis. So I think there was like some traditional framework that kind of got put into this that I think is a little bit of a mismatch logically, and this is my personal opinion. I could debate our different institutions about this, but again, that's just like again, if I was doing a portfolio of auto loans, I might want to say, well, I want to limit certain countries just in case they change the rules, and I get a proper diversification. But Bitcoin is Bitcoin, so I think we'll see as we go back to the market, some of those concentration limits get changed and maybe open up a little bit more. But there is some traditional country requirements that we have in there today.
I'm surprised that there's a 75% limit on U.S. domiciled obligors, though. Why wouldn't I'm curious as to why they wouldn't want to see that 100. Why would they care if it's 100%? You have 100%
Yeah,
obligors of, I don't know, auto loans or credit card backed loans or what have you, right?
yeah,
So it's
exactly.
strange.
You know what?
Yeah.
Bitcoin flips a lot of things on its head, right? So, like, just to have the quick conversation on it, like to draw an analogy with auto loans. So,
Hmm.
if I'm financing individual consumer credit to buy the cars, to make those cars and auto loans useful, naturally the cars are being driven in the natural environment. So, I want, as the borrower, to know that there's strong property rights and strong laws and regulations. So, if the borrower is sitting there, let's say, in Switzerland doesn't repay their car loan, I need the laws of Swiss law to work so that I can say, hey, court, enforce this so I can go pick up this car. It's reversed with Bitcoin because with the Bitcoin loans, the collateral is already sitting cryptographically, in Fidelity's possession. And then therefore the lender has possession on it. So it's almost like reversed, right? If the lender did a incorrect liquidation, then it's going to be the consumer that says, okay, I need to enforce my property right back locally. So it's the borrower who thinks about the laws and regulations in the jurisdiction that they may be in, versus because the lender already has perfection again over the collateral. They already have physical possession of it. So that's
Yep.
why, like, I think over time, it's going to be a different mindset on how they look at this as it's more broadly understood that this is different than other types of assets.
That's a really, really good point. I hadn't thought of it that way, but you're right. And it's more centralized, and it's centralized. The onus is reversed, as you say, in terms
Yeah,
of the authority that will be presumably the deciding factor. I mean, I say presumably because a lot of the, call it legal precedent that we rely on in the world of finance over the last many decades, that's been borne out over time and tested over time, has not been tested in the world of digital assets. And yes, there are laws being made and regulations being established, but there's still really, really early days. And this has been a source of frustration, I know, among folks who are championing blockchain technology, which is kind of, obviously an adjacent technology it's an integral technology to Bitcoin, but, it's an adjacent kind of industry, is putting digital finance infrastructure on a blockchain, and the lack of precedent around when things go wrong, lack of legal precedent is what I mean, is a confounding kind of obstruction for this technology to be adopted and to scale in the capital markets, at least at this point in time. We'll say we're 5 years
exactly.
away from that, from it really scaling up. But we've been saying that for a while. I do think we're getting closer. We had the Genius Act last year that set into motion, I think, putting some more meat on the bones around the regulation for digital asset financing and blockchain technology. Or in this case, it was more focused on stablecoin issuance and so on. But that's, certainly an important step in, again, I'll use the word legitimizing a narrow aspect of blockchain and crypto ecosystem, but nonetheless, it's a step in the right direction if that's where you want to see things going, right?
Yeah, exactly.
So you mentioned earlier that you have, you now securitize approximately, at least at the time of the transaction, 20% of your book. You have I'll call it dry powder that you could securitize more in the future. You have obviously I would imagine an enormous addressable market in Bitcoin alone. But maybe you can comment on what that addressable market is, not only with Bitcoin but other cryptocurrencies that are out there as well.
I think it's widely understood that Bitcoin has found its use case. Bitcoin is the gold standard store of value in the digital asset space. Jury's out whether Ethereum, Solana, even Coinbase's Base network, many other competing blockchains for these kind of more programmable aspects of them. So we don't spend a ton of time on other cryptos. We're happy supporting and building products explicitly for Bitcoin. And really what I see to really talk about the addressable market is I see a few important things happening. We think that the overall effectively market outstanding is 3 to 4 billion, and Ledn's about a third of that. So we have a 1/3 market share in consumer Bitcoin backed loans, but yet Bitcoin is a trillion plus asset. That's a lot of Bitcoin backed loans starting from 3 to 4 billion today. So we can easily see 100x growth in this asset and asset class around Bitcoin backed loans. And so that was really the impetus to us coming to the ABS market. Is we were looking around and saying, like, there just isn't enough dollar capital to lend into this space with the addressable market that we're seeing. Obviously, it's not going to go from 3 billion to 300 billion overnight, but at the same time, you got to start, right? Like, it takes time. We talked about earlier in the conversation about the work that started in 2021 now coming to fruition and making activities for 5 years later. So you have to start these conversations today so that there's enough capital later on to address it. So I think, again, just drawing to that, the ABS market, I think last year in the US, there was like over 500 billion done of ABS. So now we're talking the type of size and scale that we can tap to get to where we think the Bitcoin lending market is going.
I'm imagining 7 years ago when you were starting your Bitcoin mining enterprise, and now you're issuing investment grade rated transactions in the capital markets with room for growth. And, what an accomplishment. Again, that's why we're talking today. Just a great innovation, great, breaking new ground. And congratulations again to you and your team there at Ledn. Thank you very much. You've been very generous with your time and explanations along the way of a fairly complicated transaction, but an important one nonetheless. I think, I hope anyway, Consumer Credit Matters listeners have gotten as much out of it as I did. So, Adam, thank you very much for your time today.
Thanks a lot. Well, I really appreciate the conversation.